Welcome back to Leaders Give Back, a new Engage FI podcast that amplifies the voices of seasoned financial services executives and also shares experience-driven insights and advice to the next generation of industry leadership. Today, I'm thrilled to be joined by Gene Pelham, an Engage FI executive affiliate and the former CEO of Rogue Credit Union in Oregon. In our conversation today, we're going to tackle one of the most complex and defining moves that a financial institution can make: mergers and acquisitions. M&A is one of the hottest topics in financial services today. Banks and credit unions are looking for scale. Everybody is talking about it. We anticipate a lot more activity. Gene has not only survived M&A, but he's led through mergers, technology conversions, and cultural integrations. And so he brings a seasoned perspective on what it takes to align people, technology, and purpose during times of massive change. So whether you're a CEO or a board member or simply curious about how financial institutions navigate this kind of growth, this conversation is packed with insights that you don't want to miss. The Leaders Give Back podcast is where experience meets the future. So let's dive right in.
Hey, thanks, Virginia. This is a really great opportunity to sit down and visit about something that I never imagined in my life that I would have the level of experience in that I do. But as the former CEO of Rogue Credit Union and CEO of another credit union called Oregon Metro Federal Credit Union, have been involved in multiple mergers, from a very small $2 million credit union that their data system was on a spreadsheet built by a college student, to merger with a $1 billion credit union, to a purchase and assumption right after the financial crisis, and then also trade association mergers and partnerships too. So I've kind of been there, done that, and have seen how we have done it really well, and maybe not as well as we could have too. So.
Well, you have been through a lot of this kind of change. So you've led through it. And if I think about the M&A environment today, Gene, can you walk us through why there is so much talk about mergers and acquisitions right now?
Well, credit unions face a significant difficulty with scale. I believe scale is relative. And so whether you're a $25 million credit union, what does a $50 million size, how much scale does that create for you? But we've got 10 billion credit unions seeking scale also. And so it is a relative perspective, but I think most importantly is understanding what your competitive advantage is and what that brings to the potential partners that you're going to merge with or acquire. Many of those credit unions are looking for those credit unions that are creating value propositions that are necessary to succeed today. But I'm still a firm believer that if you understand your competitive advantage well, there is an opportunity to move forward without merger. It might be more difficult based on the resources you have, but it is possible. And I'll actually share one of my experiences was going from the CEO of a $50 million credit union, merging into a $1.5 billion credit union. And at the same time, I was hired away from that large credit union to go down and run Rogue, my hometown credit union. So we had $50 million, $1.5 billion, and $300 million in assets during that time. And I was in the planning sessions for all three of those credit unions. And guess what? The challenges, the opportunities, they were all the same. It really was the resources to take advantage of that was in front of you. And I think that was a really great lesson for me to learn, is that no matter what our size, we have similar challenges and opportunities. It's how we find and leverage the resources to succeed going forward. And sometimes that means joining with another credit union to make that happen.
So it really is a people decision, among other things, of course, but it does boil down to people. But I wanted to ask you, Gene, so you've been through mergers and acquisitions. If you look out to the next 10 years, we're seeing a lot of change in our industry. We're seeing digital first competitors. We're seeing AI driven personalization. We're seeing a brand new generation of members. that have entirely different expectations of financial institutions. Against this backdrop, how do you see the role of M&A evolving over the next 10 years?
Yeah. It's interesting if we think about this question, and it somewhat goes back to our Leaders Give Back podcast that we had recently, in where the foundation is still the foundation. The reasons to pursue a merger are still the reasons to pursue a merger. It's just some of the decision sets are a little bit different, but it still is. Are you creating value for the members? Are you creating a strategic advantage? Does this skill set give you the opportunity to compete in a better way than you did in the past? And so whether it's AI or a better marketplace reach, all of those things still come the same. I think it is difficult in the perspective of now we've got to measure the value of all those individual skill sets a credit union is going to bring to bear. But in many ways, use of AI can maybe make the merger process simpler as we go forward, whether it's the conversion sets and those types of things too.
Oh, I love that you said that, right? Because I think the industry generally views AI still as being inordinately complex. And what you're saying is, hey, this can actually make the whole process of integrating much easier when it comes to technology.
Yeah, and I agree. And I think probably one of the things that especially smaller institutions need to embrace is that AI could give them the opportunity to compete against a larger competitor because they're gaining skills and abilities they wouldn't normally have access to. And so in many ways, I think part of the decision is can you leverage the tools that others are using to grow and prosper, to help your organization grow and prosper too. And so I think it's actually kind of exciting is that I think there are really more opportunities for strategic focus, determining your strategic future as an organization. And most important is clearly understanding what your competitive advantage is and how you can execute upon that. And your competitive advantage at one asset size needs to be significantly different than the competitive advantage of a larger asset size. And you have to be very good at it, which means oftentimes the smaller the size, the more focused that competitive advantage is. But with that, you have really a great opportunity if you can hone it down. We all try to think that we want to be Bank of America and have all these resources and assets. Our members aren't looking for all of that. We just have to find out what they need the most.
Yeah, great point. It's understanding who it is that you're serving and building an organization with that in mind.
Absolutely. If I'm looking at it from a credit union perspective, we have to set our personal interests and biases aside and focus on what's best for the member. And I've been on both sides of that equation, in that what's best for the member is combining, is joining, is creating greater value for that member. And value is not always determined by price or product. It's determined by the ability to connect, have an impact on their community, create meaningful, viable employment, all of those things that go with that. So it's really kind of, I think, as we go back to the original question, it's an exciting time to understand. And as we have leaders that understand their strategic opportunities more and more, we have a lot more strategic choices in the merger and acquisition area right now that allows us to create the organization our members deserve.
Now, there are a lot of decisions along the way, right, Gene? I mean, when you're talking about delivering to the member, to the customer, depending on what type of financial institution this is that we're talking about. Now, there are decisions along the way to make sure that there's a positive outcome for the member and the customer. Looking back at the mergers that you've been a part of, what is one decision in the early stages that you feel made the biggest difference in whether the integration was ultimately successful?
Yeah, and it took me a while to learn this, but I still think back to the purchase and assumption that we did of the credit union that was the third largest loss in the NCUA history after the financial crisis. But there was a significant opportunity for us, but it was also a significant risk. We were purchasing the credit union from the NCUA, a little significantly different than a merger, but all the pieces were similar in what we had to do. And I think the number one decision that we made as a leadership team was, why are we doing this? What's our mission? What do we want to have happen on the other side of this? I think with every merger and acquisition, there has to be a purpose, of course, driven by strategy and member/customer need, but also how is that organization going to be better because we're involved? And when we got really good at defining that, it was easy to bring the new employees on board is because they saw that mission as a value and also a purpose for them. It wasn't just a takeover. It was, this is how we're going to build a partnership to make not only our credit union, but your credit union more competitive, more desirable by the members, more impactful to the communities that we serve. And so I think really having that driving non-negotiable purpose and mission at the beginning really makes it easier to go back and review whether you created success or not.
That's really insightful. Now, how do you measure the success of a merger once you're through it?
Yeah, at least the numbers that I was told is expect a 20% decline in deposits, expect a 20% decline in membership in any merger that you put together. And so our objective was always to make sure there was no decline in deposits and no decline in membership. And we were really fortunate by creating value and making a significant impact. And of course, choosing the right partners. I think that's the important part, is to see significant membership growth after a merger comes together. And so I think that's probably, for me, yes, we've got the financial integration and so on, but those benefits are realized much later, 2, 3, 4, 5 years down the road. Mm-hmm. But I think the early indicators are people like the new value proposition. They see the community has seen the opportunity to get services and products, and they are voting yes by becoming members of the credit union. And that's kind of fun for me to be able to go into a credit union, because there's significant fear from the community, from the members, from the staff members about how a merger or acquisition might decimate any one of those. And so when you go back and you start talking about the community impacts from the service agencies and the donations you're able to make and the partnerships you're able to make, to see members grow and to see staff members see opportunities that they weren't going to see in their current organization, all of those things are a huge victory for me.
And a big part of this is culture, Gene, right? I mean, that's success ultimately boils down to whether or not there is that cultural compatibility between these two merging organizations.
Absolutely. And I think probably if we look at things that we miss early on, is we see the strategic opportunity in the merger, but is there the opportunity to create a cultural partnership? And it's not taking over someone else's culture, but it's finding a way to take the best of their culture and join it with your culture to keep the organization moving forward. And part of that is the partnership up front. One of the things that I like to say is we have to talk the talk and then walk the walk. And especially from a leader in a merger position from the acquiring institution is, man, you better under-promise and over-deliver. Because every promise you make that's not delivered upon just is one of those things that delays the acceptance, the joining together of those two cultures and those meetings. So I think trust is huge, and it's really hard because you have to keep so much secret up front and you have to do all these other things and so on. But just as a leader, I just challenge you, don't say things you think can happen, say things you know will happen, and then deliver upon that. And then all the things you think that can happen, make them happen and make people happy that they got more than they bargained for.
people internally within the organization and also the members and the customers.
Yeah, absolutely. I'm a firm believer in stakeholder strategy. And from that perspective is that we have to understand the needs of all of those that count on us in this organization. And so it's not only members, staff members, it's the community.
Mm-hmm.
It's the ability to create a livelihood for people that have invested in this community and want to see their community succeed. I've always been a firm believer that if the community is strong and we have the opportunity to help make that community strong, then we'll always be strong following that.
Yeah, so we hear a lot when there are mergers, especially in the credit union world, where culture is just such a strong motivating factor when folks choose a credit union. How do you keep members from feeling like they're losing their credit union during a merger? What do you say to leaders about how to approach member communication?
Well, I think one of the things that we as leaders need to do is that our members don't consume credit union products and services in the way that we do. We have knowledge, we have access, we also have simple access to the various services and so on. And because we understand the financial services environment, we have a way maybe to kind of shortcut services and do that. Our members, for the most part, don't have that. And I think what we have to do is we have to understand the real and meaningful impact to members going through the merger. Perfect example of that is as I was getting ready to retire from Rogue, we merged with a credit union, which was 7 hours away. It was a 7-hour drive away. But the new CEO at Rogue, Matt, was kind of being tested by the board. And so I had time. And so I went over there to be part of that credit union and talk with members during difficult times. And I still will remember the days that we did our internet banking conversion. And so I stood in the lobby and I visited with members. And I was just amazed, even though I thought I was kind of a man of the people and I understood what our members wanted. It was incredible to see the people come in with sheer fear on their face because they didn't know what a browser was. Somebody had set their phone up, they'd given them their password, and so now they had no access to their finances and they didn't know what to do. And oftentimes it's perceived that that's maybe a more mature member, but these were very young members too. It was a rural environment. They weren't tech savvy in all the ways that many folks that live in an urban area would be. And so understanding that we are creating real and a meaningful impact to our members and that we can't discount it. We really have to go through and make sure every decision is made from a member's perspective, through a member's lens. And even though we might see it as trivial, I tell you, Virginia, looking at somebody's eyes that's scared to death because they don't know how they're going to get access to their paycheck that was deposited this morning, that's a real sobering thought. And so it's been really important for me to speak to leaders about making sure we live our credit union the way our members actually do. At the majority of our members. Yes, we have high technology, highly capable members, but that's not all of them. And the ones that need us the most are the ones that maybe might be least capable from understanding how to manage the change.
Yes, and it seems almost that there's no way to over communicate in a merger and acquisition. The more information, the better. The more that we can help our members feel comfortable about the change that's happening, the better they're going to feel about the outcome.
That's one of the things I always appreciated about the board at Rogue Credit Union was allowing us to invest in the communication that was necessary. And so we would go through and look at whether it's internet banking clients or somebody else and identify those that would be most impacted by the change and then make personal phone calls. We would make personal phone calls to give them a heads up. Sometimes we're saying it's going to be difficult, but we just want you to know we're here for you. And I can tell you, Virginia, that little step created so much more acceptance and willingness to try to manage the change Yes, we always have those members that are pounding their fist on the table and saying, I don't want this to change. But just reaching out, understanding the impact, and highlighting or directly contacting those members most impacted was huge. Because
Yeah.
guess what? Those members post on social media that the credit union's taking care of me, they're good people, they care about me, and it just kind of snowballs into a positive effect. I will share another example of you is when we did the purchase and assumption. We had a process that was called Ask Gene, and so members could email me with their questions or concerns. And the first 2 nights after the purchase and assumption, because it was a surprise for the members, they weren't told until the day it happened, because that's NCUA had to do their various things. I answered over 200 emails with members talking about it and helping them understand why the change was made, what the various impacts on them would be, and so on. And that just kind of created this positive word of mouth in the new communities that we were serving, is that, gosh, they're real, and we can talk to them.
Yes, I mean, the advice is tremendous, Gene. What I'm hearing you say is, if you're a leader, be a man or a woman of the people, get out there, get in front of your members, in front of your customers, stand in the lobby, have those conversations, and suddenly you'll see that there is a big difference.
You will make different decisions, and you will make better, more member-focused, member-informed decisions in the process. And you're not going to, I guess, hurt the process. You'll actually speed the process up, because guess what? Me standing in the lobby facing those members directly, every new team member saw that we cared about the members, that we cared about what their experience was about. And so they cared even more than they had before. It wasn't just that we were remote and we were just going to merge them and dump them. No, we came and we were committed to being part of that process with them, and walking the walk, and making sure that we were delivering on it. I will go back over and over again, especially in any kind of major change, whether it's a merger or acquisition or a technology conversion. Under promise, over deliver. Transparency is important. Honesty wins every time, and so the more honest, the more truthful you will be, the more honest and truthful your staff and members will be with how the process is going.
Sure, and employees and staff, they have their concerns too about a merger. There's a lot of uncertainty for them to process. How do you keep morale high, Gene? How do you keep talent engaged through this kind of a transition?
Well, under promise, over deliver, be honest and transparent, but also understand the lens that your staff is seeing this purchase and assumption or merger from. Most of them only see the bad things reported about Fortune 500 mergers, where they've exited this community, they've eliminated all these positions, and so on. Credit union mergers are very, very different in the purpose and objective of them. It's to create strategic advantage. It's to be able to grow their services. And so be honest with staff members, but understand that they see it one way, and we have to be honest about the way it will be. And once again, that's why I say under promise, over deliver, because if you promise something that you don't deliver on, they'll remember that forever.
Yeah, absolutely. Absolutely. Now, getting into the nitty gritty of mergers and acquisitions, there's just so much to think of. I want to talk about cost, right? Because the cost of a merger, obviously, that's something that we have to plan for. We have to have some idea what the runway looks like. Are there any invisible costs of mergers that, Gene, you feel that boards and executives often underestimate until they're smack dab in the middle of the process?
Until you kind of build that merger and acquisition muscle as an organization, and you do that over time as you learn how to prepare things to anticipate and so on. It's very difficult to understand the strategic impact, the executional impact that a merger creates for an organization, because you're taking and refocusing entire teams that were focused on moving the organization forward to bring them together. And so I think one of the biggest costs that you see is kind of losing some of those strategic opportunities for the organization during that interim time period. Of course, you're investing that time to create a bigger strategic opportunity, but there are things along the way that go that can impact it. Also, I think the other thing is because we have staff so focused, the ability for our ongoing development and helping them grow as individuals maybe sometimes is impacted through a merger and an acquisition, because it is an all hands on deck type perspective to get everybody going forward. And so sometimes you see a little bit of that capability capability growth slow down during that process. But going back to the initial statement of the costs, I think one of the biggest things that keeps leaders from delivering on their promise is the lack of understanding of the costs that are involved in a merger and acquisition. Yes, we're acquiring capital from the new institution, but there are so many things from conversion costs to legal costs to rebranding to the regulatory filings and the member votes that you just don't realize how much those expenses are. And so I think having a really clear, firm understanding of the cost of merger up front will allow you to be a better merger partner too.
Yeah. And when I think about that, just the complexity and the environment that we're in, Gene, we talked about this in the beginning of our time together. The world is moving faster. The industry is moving faster. Innovation is happening at a faster pace. AI is here. And of course, you mentioned it, when you're in the middle of one of these M&A processes, you're slowing down, right? Because you're focused on making sure that the merger goes the way you want it to go, that the purpose, that we stick to it, and that the member, the customer's happy. But in this environment, it almost seems like we have to be very efficient in the merger and acquisition process. Efficient with the cultural integration, with the technology integration. How do you balance the pressure for speed with the risk of mistakes that could basically erode member trust?
Yeah, I believe speed is gained by strategy and being clear about the strategy, being clear about the plan. And I'm not sure that's what we do very, very well at times. Because we just haven't built the merger muscle. We don't know some of the things that come up or what to plan for. So I think having a merger plan that is as strong or solid as your current operating plan is critically important, because just the simple part of the balance sheet valuation process and all that goes into that it's expensive, and it has to be planned for, and you have to involve third-party vendors to validate that, and all of these different little steps. So going in and having that clear understanding of the decisions you need to make, the timing that needs to happen, and having a clear plan will drive that speed. And if you don't, it's going to take much longer than necessary. Right now, the NCUA is doing a pretty good job at approving mergers in a timely basis if the plans are submitted thoroughly and so on. So it really is up to us. There are less obstacles in making a merger happen than maybe there were 5 years ago.
Mm-hmm. And technology conversion, that's really the moment of truth in a merger. You've done the work, you've identified your merger partner, you've bridged any cultural gap that may exist, you're going down the road. Then there comes that day when you have to make the technology switch from one system to another. And there's not just one system, there are multiple systems in an organization. What have you seen as the difference between a conversion that is smooth and a conversion that just creates disruption for members?
Maybe self-serving because of my role as an executive affiliate at Engage FI, but having a really good partner that knows what to do and prepares you for this. I think one of the biggest issues we see right now is quality of data. We've not been real good at the quality of data, and we're getting two different vendors with different data sets and all of the thing, and trying to get them to combine that data accurately when it's bad data in the first place is really, really important. So having an outstanding partner like Engage FI to help guide you through that, I think, is really critical in this process. And building those relationships with the key vendors in that process, I think, is very, very important. They have a lot to do. It's not easy for them to bring data from someone else and make that data just look perfect and hum on day one. And so we have to partner with them and work with them to do what's best for the member. One of the things that I always did is I sat down with our vendors and specifically explained our vision, our mission, our values, and how we expected our work with that vendor to come through. And as a former partner of Engage FI, you guys did that very well for us. So I think that's really important, is building that partnership. But oftentimes we're better at the data conversions, the system conversions per se. But what I've seen is card conversions and internet banking conversions can be incredibly problematic because we hit people where they live that moment. The ability to gather information and make a decision about a purchase that day by looking at their internet banking in the morning. If that's taken away from our members, oh my goodness. Or if it's different, I always challenged my staff to think about what happens when we move their buttons. And it might seem silly, but I live with people who are not as technically savvy as others. And so you move a button, just one button on an internet banking site, and all of a sudden people can't find it anymore and they have to be hand guided to it and so on. And you would think that because of technology the way it is today, that many people have acquired that skill and ability, but they still haven't. And so understanding the buttons we've moved, preparing our staff to deal and solve those, answer those questions for our member quickly are really important. And you see, I continue to get back to the very specific member issues, but the whole thing is success is determined by whether or not people want to do more business with you, and they will if you care about them in the process.
Now, Gene, if you were mentoring a first-time CEO, this is sort of the question to bring us home on the podcast. First-time CEO, they're about to go through their first merger. What is the one piece of advice you give that they need to know?
I can't say it enough. Under promise, over deliver. It's so critically important because as we talked in our previous podcast, trust to me is the foundation of being able to move an organization at speed. If your team trusts you, you can ask them to do things that maybe they wouldn't normally want to do, but they know that you've got their best interest in mind. And so I think you build trust as a CEO, as a leader, from day one in the merger and acquisition process, whether it's with the other senior leadership team, then the board, because the board will hold you accountable to the board of the acquired credit union will hold you accountable to every promise that you made in the process. And then staff are uncertain. They just automatically think they're going to get fired anyway, because that's what happens in mergers for major companies. And so being honest with them. I still remember when we did the purchase and assumption, and we couldn't tell staff until right before the purchase and assumption, and they were scared to death and go, well, we don't have any chance. We're not part of this organization. Our opportunities to grow won't be there. And I remember sitting down with two staff members specifically, because they pulled me aside afterwards because I allowed that to happen. And they said, what's going to happen with us? And I said to them, I cannot tell you exactly what will happen with your role or your position. You are guaranteed a position at the credit union as long as you don't do something dumb. But I can promise you is if you work as hard to help this merger go through and the members to accept it, then you're going to be a hero not only to your members, but to us. And that will always create opportunities for you. And within, I think it was 6 months, both of them had manager roles that they didn't have before, because they engaged, they did what needed to be done to move the organization forward. So to go back to your original question, under promise, over deliver, and understand that you're building trust from the very first statement that comes out of your mouth with that prospective merger partner.
I can't think of a better way to end this episode, Gene. Thank you so much for your time today, for your wisdom.
Yes, well, thank you. And it's been fun working through the process with these because you learn something new. But there are great partners out there to help you through that process and make sure you seek them out, and your merger will be a success.
Thanks for that, Gene. And that's a wrap on today's episode. What I hope you take away from this is that mergers and acquisitions aren't just about balance sheets. They're about people. They're about culture and the experience that a human being has engaging with their financial institution. Gene said that so well, emphasizing how important people are, both members and employees, and how it really pays off to be in front of them when you're going through a big change like this. Technology conversion, it could be the most visible challenge, but success ultimately comes down to leadership. How do you create trust? How do you communicate clearly? And how do you stay grounded in the mission of serving members and customers? Huge thank you to Gene again for sharing such candid lessons from the front lines. You're going to be hearing a lot more from Gene as he shares his leadership lessons across a whole range of topics right here on the Leaders Give Back podcast. Please be sure to look out for our next episode. Follow Engage FI on LinkedIn. Until next time, be well and have a great rest of your day.